As I record this video, the average 30-year mortgage rate in America currently stands at 7.83%. Remarkably, this rate is the highest we've seen since December 2000, approximately 23 years ago. This situation is particularly striking for individuals entering the housing market today, as they, and possibly even their parents, have likely never experienced or been aware of interest rates of this magnitude. We are witnessing a generational high in mortgage rates, which has profoundly impacted the real estate market. Furthermore, the situation has deteriorated significantly when considering the trajectory of housing prices over the past 3 years. This deadly combination of rising interest rates and escalating prices has created a ticking time bomb, poised to bring down the precarious housing market at any moment. With rates edging towards 8%, there's growing speculation and concern that this could be the catalyst to burst the massive global housing bubble, as evidenced by reports of market slowdowns in various hotspots throughout the United States. Now, turning our attention to the most recent data to verify these rumors, we are left wondering, is the ground starting to shake? Is the mega bubble finally popping? To provide some context, on January 7th, 2021, the average 30-year mortgage rate in the United States was at a historic low of 2.65%, the lowest since records began in 1971. Although data from the years prior to 1971 may be unclear, with a bit of digging, it's reasonable to conclude that this was likely the lowest rate in American history. This rate is likely the lowest in American history. From this unprecedented low, mortgage rates began to rise at an unimaginable pace, nearly tripling in less than 3 years. Simultaneously, the average price of American homes experienced a rapid increase. During this exact time frame, the Case-Shiller Index, which tracks typical home prices in the U.S., surged by 32%. This convergence of factors resulted in what can arguably be described as the most expensive housing market in history. According to the latest report, which doesn't account for this week's increase in rates, the typical American mortgage payment now stands at $2,600 per month. For perspective, not long ago, this figure was $1,300. This means that mortgage payments have almost doubled within the time frame under discussion. From an affordability standpoint, it is unsustainable for new buyers to continually support this unusual market in the long term. To illustrate the severity of the situation, consider the insights from the world's leading personal finance expert, Dave Ramsey. Many regard Ramsey's home affordability rule as the gold standard for determining how much house one should buy. This rule advises a 20% down payment on a 15-year mortgage, with no more than 25% of your take-home pay allocated for the mortgage, taxes, insurance, and other related expenses. Applying this rule to the current market means that to afford a $300,000 house, a household would need to earn around $182,000 annually. Therefore, to afford an average home in an average American city under these conditions, a household needs to earn more than what 90% of American families bring in. To afford a home in an American city under the current economic conditions, a household needs to earn more than 90% of families in the U.S. In summary, one must be quite affluent to afford even a modest house in the country, given the volatile market conditions. Considering the significant role housing plays in driving the economy, the limited number of families that can participate in the housing market is insufficient to sustain it. For over 3 decades, we've experienced an unprecedented era where mortgage rates have consistently decreased. A quick glance at any 30-year mortgage chart from the past 50 years will immediately tell a tale of a real estate century where rates have been on a decline for an entire generation. This decline naturally led to an increase in housing prices. As Warren Buffett aptly described, interest rates act like gravity in the financial world. The higher they are, the less likely it is for prices to rise. For the past 30 years, this financial gravity on homes has been exceptionally low, causing prices to soar. This trend was expected and understood by economists, as it was a natural market behavior explained by the low interest rates. However, the recent sharp increase in rates has disrupted this understanding, making the current market behavior perplexing. Market forces are bound to initiate corrective actions soon, as explained by renowned bubble historian Jeremy Grantham when questioned about the present housing market. Before delving further, take a moment to like and subscribe, as each like fuels the algorithm, promoting the video and supporting the channel. Also, check the description below for a link to the full podcast video for more insights from experts like Grantham on the current state of the housing market.
No one can afford to buy a house now.
Yeah.
No young kids coming out can buy a house. This is not a stable equilibrium. Furthermore, the mortgages have gone from 3, which explains everything, to 7, which explains nothing. And eventually the 7 will start to explain quite a bit. But how long does it take? I mean, just think. The first reflex is, I can't move, for God's sake. I can't afford to go from 3 to 7.
Sure.
So I am going to stay, which means no houses are on the market, which means for the handful of people who have to move, they're actually in a bidding war.
And prices stay up.
Yeah. But so real estate has never been about 3-month predictions. It works slowly but surely. In the end, you pay more because you could afford to. In the end, you will pay less because you can't afford to. House prices will come down in everywhere from Australia. Mentioned that in Australia, it's World War III instantly. They are more optimistic than Americans, and they
really?
hate any idea that they're real
But Jeremy,
estate.
by how much? Because I agree, housing prices, it's an awful issue for people that are looking to get into a home. Are they going to come down by 10%, down by 30, or?
30 would be a pretty good guess.
As Jeremy just elucidated, the straightforward explanation for the ongoing scenario is the fluctuation in rates. With rates experiencing a significant jump, it's logical to anticipate a corresponding drop in prices. Although there isn't direct evidence manifesting at the moment, the market is exhibiting early signs of an impending downturn. It's crucial to note that most real estate data tends to lag behind the actual on-ground happenings significantly. However, one reliable indicator is the market itself. Last year, there was a noticeable market downturn, as evidenced by the Case-Shiller Index in June, with prices expected to fall close to 6%. Interestingly, on-ground situations had been deteriorating for a longer period than what the index indicated. Many had foreseen this decline months in advance by closely observing the trends among home builders. Home builders have been experiencing a decline since December of 2021, a full 6 months before the fall was reflected in the Case-Shiller Index. The chart depicting home builders' performance is often a reliable predictor of near-term market trends. Currently, after almost a year of robust growth, home builders are facing significant challenges, with confidence in the sector dwindling and future prospects appearing increasingly bleak. Starting in late August, there has been a noticeable decline in home builder stocks, with mortgage rates pushing towards 8% and the housing landscape becoming progressively unaffordable. The sentiment in the industry continues to worsen. Builders' stocks have declined around 10% over the month, and the situation is beginning to resemble previous downturns, with the crucial difference being that rate relief is unlikely to provide respite this time around. With incentives dwindling, builders are likely left with no other viable option but to implement price cuts, given that the prices of new and existing homes are currently closely aligned. Any price reduction in the new home market is bound to affect existing neighborhoods adversely. This scenario will lead to further challenges in demand for existing homes, initiating a price spiral driven by home builders, which is expected to result in dampened prices in the coming weeks. In the ensuing weeks, it will be imperative to keep a close watch on interest rates and the stocks of home builders, as these indicators will narratively illustrate the market's trajectory for the remainder of 2023 and lay the groundwork for 2024. Thank you for watching, and if you found the video insightful, please hit the like and subscribe buttons to support the channel.